Does Martingale help a futures trading strategy? In this video, I'm going to try and find out. Okay, so can $10 become $1,000 just by doubling down? It seems easy until it isn't. So today we're going to be exploring Martingale strategy, how it works, why it's dangerous, and could it be used smartly as well? So first and foremost, what is Martingale? So you start small, let's say $10, you double after every loss. So $10 trade becomes 20, 20, 40, 40, 80, so on and so forth. The idea is to recover losses with one win, and then that will recover all your losses and you will make whatever you were trying to make initially. So in this case, maybe you're trying to double up your $10 to 20. You'll get your $10 back and your loss. There is a catch though, it assumes unlimited capital. Okay, so you need a lot of money to make this work. So here's how fast it scales. So if we look on a chart, let's just imagine where would we be? We'd be sort of here at the bottom of this big, what's it called? This here, you know, it's gone down and then suddenly it's just continuously heading up. So you would be sort of here and you'd lose. So you'd be going, oh, goodness me. Okay, $20. And then you'd lose again and you'd be like, oh, okay, I need to go to... I've lost me $10 and I got $20. Oh, I've lost again. $40. Oh, I've lost again. $80. I've lost again. $160. Oh, I've lost again. $320. Lost. $640. Lost. $1,280. Lost. $2,560. By your ninth trade, you've risked over $5,000 just for a $10 profits. Now, that is not sustainable for most people. But why do traders try it? Well, small wins will give you a false sense of confidence. High win rate environments. Martingale looks like easy money until a streak of losses completely wipes you out. So here's a real life example. Let's say we're trading crude oil with $100. You lose 10. You double up, you lose 20, you double up, you lose 40, you double up, 80, double up, and then you win, and you get back to just a $10 profit. But if you lose once more, you're out completely because you've lost your entire trading bank of $100. It's huge risk for very little reward. So it can work. Very rare that it does, but here's some things that you need to do. Right. So if you've got a trading strategy with a 70% plus win rate. For example, the strategy I use at the minute on oil has higher than 70% win rate. So it can work there. If you've got a very large account, you've got a lot of capital. You're using fixed Martingale steps. So rather than doubling up every single time, perhaps you're going, oh, well, if I've lost 10, I'll double up to 20. But then I've lost 20, well, I'll trade 30 and 40, so on and so forth. So you're not doubling up. Gives you more steps before you're completely ruined and out of money. You pair it with good technical analysis as well. So like I say, soft Martingale, 1x, 1.5x, 2x risk. It gives you more steps so you can slowly try and regain some of your loss back. So you might not make it all back in one trade, but you'll regain some of it. There is a psychological trap when it comes to Martingale. A lot of people think, well, it's easy money, but it's not. It's not just risky; it's also emotional as well. Hope fuels doubling down. Stress and panic take over, and then no rules. You're just gambling. So what I mean by that is, if you lose 3 or 4 in a row, when you're martingaling, in your mind, you're going to think, oh, the market's against me. Oh, this is ridiculous. I'm just going to gamble now. I need to get the money back. I'm in such a bad, black hole. I'm never going to lose again. I've lost 4 in a row. I'm not going to lose a 5th time. And you'll lose. You'll gamble. You make silly mistakes and you'll lose. And also, I think time frames do matter as well. So very short time frames, when you're going under the 1 minute, it's noisy. It just doesn't help. 5 to 15 minute charts, probably better. Try demoing it first and don't risk capital without testing 100 trades plus on maybe a demo account or on TradingView or whatever. Are there smarter strategies than Martingale? There are. You could use a fixed percentage risk. So, for instance, 1% of your trading bank. You could aim for high risk reward trades. You could scale in and out, and you could base your system on stats, not just hope. There's a reason why prop firms don't allow Martingale 9 times out of 10. For the most part, they don't. So all in all, it can work, but only with capital, control, and a very good system. If you want to know about a system, there is a video that I've done about the system I use on oil, which doesn't use Martingale and provides a very high risk to reward, very high win rate. It can be used on a prop firm. It gives you pretty much a trade every day. It's very mechanical. What I mean by mechanical is you'll get there's a list of rules, and if you meet the rules, you take the trade. So I'm not saying there's no thought involved, but a mechanical system is better because you can apply rules to it, and it's easier to trade for the most part anyway. So for most people, Martingale is a trap. People will say, oh, this is really good. I can't lose. And for maybe a few days or a week, you won't lose. Well, you will lose, but you'll get your money back, and you'll think, I'm a millionaire now. But it'll lead you into a false sense of security, and you'll end up probably losing your capital. So let me know if you've tried it. Comment below, like and subscribe as well for more strategies and more trading discussion. Bye for now.